Welcome to The Explainer. Today, we're diving into the mind of a perennial optimist during one of the most volatile decades you can imagine. We're talking about the Y2K scare, the dot-com bust, 9/11, and all the massive global shifts that came with them. So how does a bull survive and even thrive in that kind of chaos? Let's find out. Okay, you gotta love this quote from economist John Kenneth Galbraith because it really sets the stage for us. We're digging into the core ideas from Dr. Bob Froehlich's A Bull for All Seasons. And really, we're asking a pretty simple question. How do you find the money in any market, especially when so many experts get it so spectacularly wrong? All right, first things first. To be a bull, especially back then, you had to see the world in a completely different way. Froehlich's big argument was that the old economic rules, the ones everybody took for granted, were being completely rewritten right before our very eyes. He pointed out that looking at old data was kind of like trying to drive while staring only in the rearview mirror. For instance, economists would just obsess over holiday retail sales. But see, counting how many Barbie dolls flew off the shelves, well, that just didn't work anymore. The real gifts were becoming plane tickets, cruises, sporting events, stuff that never even showed up in those old-school sales figures. The economy was changing, and it was changing in a really fundamental way. And this wasn't some kind of old economy versus new economy death match. No way. The real revolution, where the real money was in these old school companies using brand new tools to get hyper efficient. I mean, think about it. Southwest Airlines, a classic old economy company, right? Suddenly, they're booking a quarter of all their passenger revenue online. That's not a battle. That's a powerful, powerful merger. So instead of getting caught up in the daily waves of the market, Froehlich said to focus on these four massive icebergs, these deep underlying currents that were really driving everything. You had the internet, which was just revolutionizing, everything. You had global free trade, connecting economies like never before. Demographics, and this is a huge one. 76 million baby boomers were hitting their peak earning and saving years. And on top of all that, a massive surge in productivity. If you understood these forces, the day-to-day market noise, it just didn't matter as much. Okay, on to his second principle, and this one was a simple but really powerful mantra for finding growth. You had to completely expand your frame of reference. While so many American investors were just completely fixated on the domestic market, the real explosive growth was happening somewhere else entirely. The advice was simple and direct. You've got to look beyond your own borders. And look, the numbers from that time, they just speak for themselves. The U.S. market was down almost 3.5%, okay? Meanwhile, you look at China, up over 25%. Hong Kong, up 16%. Brazil, Mexico, both up in the double digits. I mean, the opportunities were just immense, but you had to be willing to actually look for them. And here's the real kicker. Even if you only invested in U.S. companies, you are already investing globally, whether you realized it or not. How? Well, because a stunning 17 of the top 25 global brands at the time were American companies. I mean, just look at these brands. The U.S. had a clean sweep at the top. And what do these companies do? They attract global capital. Their success isn't just tied to the U.S. economy, it's tied to the whole world's economy. So when you bought Coca-Cola stock, you weren't just betting on America, you were betting on the world. Okay, so you know the new rules, you know where to look, but that's not enough. Not even close. Froehlich's third principle was about mastering the most volatile, the most unpredictable, and the most difficult market of all, the one that's right inside your own head. Perspective is everything. You see, reacting with your gut, emotionally, when you don't have all the facts, that is probably the single fastest way to lose your shirt in the market. And to illustrate this danger, he told a really simple but powerful story. So picture this. There's a guy at an airport. His flight's been delayed for hours. He buys a newspaper, a bag of pretzels, and he just settles in to wait. Then, a stranger sits down next to him, doesn't say a word, reaches over, opens the bag of pretzels on the table, and just calmly helps himself to one. The man is, he's irritated, right? He's thinking, the nerve of this guy. But he's not the confrontational type, so he just kind of glares and takes a pretzel himself. And this goes on in total silence, back and forth. He takes one, the stranger takes one. And with every single pretzel the stranger eats, the man is just getting angrier and angrier, just fuming inside. Finally, they get down to the last pretzel, And the stranger, he picks it up, breaks it right in half, gives a little smile, and offers him a piece. And that's it. That's the last straw. The man just snatches his half, totally furious at the nerve of this pretzel thief. Just then, his flight is called. He is so relieved. He grabs his stuff, boards the plane without even a glance back. He sinks into his seat, opens up his briefcase to get his newspaper, and there it is, his own completely unopened bag of pretzels. And in that one moment, this wave of horror just washes over him. The stranger wasn't stealing his pretzels, he was sharing his. He was the thief. He was the rude one. The moral of that story is just absolutely crucial for any investor. You see a piece of news, the market dips, and what do? We react. Instantly, we assume the absolute worst. We panic, we sell. But are you absolutely sure you have the full picture? Are you certain you aren't eating someone else's pretzels? So, what does this all boil down to? It's about taking all of this, the new rules, the global market, your own psychology, and making a conscious choice about what kind of investor you're going to be. Froehlich uses this great Cold War analogy to present the choice. Think about it. You have a finger, and you have a big red button. The finger is twitchy, nervous, ready to push that button and cause a meltdown. As an investor, you have to decide, which one are you? So ask yourself, which one are you? Are you the finger? Twitchy, ready to react to every single bit of bad news, every rumor, every scary headline? Or are you the button? Are you part of the system itself? Calm, focused on those long-term principles of a changing global economy, and trusting the perspective you've worked so hard to build. In any market, in any decade, that's a choice every single one of us has to make.